pleasure now to bring on board Mr. TV Narendran, CEO of Tata Steel. Mr. Narendran, fantastic to have you on ET Now. Thank you for joining us. Before I get into specifics, let's talk about the big picture for the quarter gone by. If I look at the sequential comparison, a year-on-year comparison, the realizations, the purple patch for the steel sector continues.
Yeah, Nikunj, thanks for having me on the show. Yes, I think we are in a good place as far as the industry is concerned from a demand perspective, with multiple governments across the world focusing on infrastructure, including our government in India. Second part is the costs are on the higher side given the input costs at record levels. And thirdly, China, despite a bit of a slowdown, is not exporting much because they're cutting production month on month. So overall, the sector is in a good place.
So specifically, once talks about the challenges for the current quarter. We've seen a wild swing, sir, in coke prices, especially how China is cutting down on the capacity. We've seen a lot of volatility in the iron ore prices. So what happens to the steel prices given that the raw material prices are fluctuating so wildly?
Yeah. So yes, there is volatility in steel prices. Even if you look at the steel prices in the last 3 to 4 months in Southeast Asia, the hot rolled coil prices fluctuated between $850 and $950, went up and down twice, right? So to me, there is that volatility because of raw material prices. But even today, the raw material prices are at a high level. So coking coal prices for Indian importers are in the $380 to $400 range. And for China, it is in the $550 to $600 range. So when you're buying coal at that price, it is very difficult to sell steel at much cheaper prices than is available today. So I think that's the big change. Second thing is iron ore prices have dropped, but seems to have stabilized around $100. And third point is because China is cutting production. In fact, every month, Chinese steel production is lower than the previous month's production. And this is expected to continue, and China is not going to be exporting a lot of steel. That gives a lot more stability to global trade in steel, and hence steel prices have stayed at a higher level than we've seen in the last 10 years.
So can I say that one is volatility, which obviously will happen after the last 1 year price appreciation. But in terms of a directional trend, steel prices, in your understanding, will remain firm. They may remain volatile, 5%, 10%. That's nature of the cycle. But directionally, prices are headed higher.
So what we've guided is this quarter, for instance, in India, prices will be about 2,500 rupees higher than last quarter, our realizations. And in Europe, it will be about 25 to 30 or 35 pounds per ton higher. So also because we have long-term contracts, both in India and in Europe, with segments like the auto industry, where prices are being renegotiated. So that is one thing. Secondly, as auto industry demand picks up, it helps us in the mix. So for multiple reasons, we expect realizations to be trending up for this quarter as well.
There is finally good news coming from Europe. That, in a sense, has been the swing factor. If I scan through what updates have come from brokerage reports, our understanding of your number is that Europe has been the swing factor. Is this normalization of demand which has helped the European business?
So Europe, if you look at it, Q1, everyone was disappointed because in Europe, Tata Steel Europe has a larger proportion of long-term contracts than most of its peers because we are a very strong player in both the auto and the packaging industry. So as a consequence, we were not able to see the benefits of rapidly increasing prices in Q1. But as the contracts got renegotiated, as we started, also getting better prices from the spot markets, you see the improvement. So the European EBITDA is actually doubled in Q2 compared to Q1 and is expected to stay strong for the rest of the year.
But for the quarter gone by, would you say that the domestic demand per se was not very satisfactory?
You mean domestic demand in India?
Domestic demand in India, that's right, for Tata Steel India business.
Yeah, so normally the July-September quarter is the weakest quarter for demand in any year because it's the monsoon time and construction activity slows down. And construction accounts for 60% of the steel consumption in the country, right? So this quarter was no different. But what happens normally, it is typically a strong quarter for the auto industry. because you're preparing for the festivals and the offtake, etc. This time was not a great quarter for the auto industry because of the semiconductor issues for the passenger cars, and commercial vehicles were slow to pick up. But we are seeing in the last few weeks that the commercial vehicles business is picking up, which is good for steel because the steel intensity in commercial vehicles is much higher than in passenger vehicles. So overall, we are expecting the next 2 quarters to be better from a demand perspective in India. But otherwise, Q2 demand in India shrunk by about 2.5% compared to Q1.
And do you see that normalizing, like you said? I mean, do you see that whatever you've lost in Q1 would actually be more than made up in next 2 quarters?
Yes, in terms of volume, yes, to a large extent, we will make up. We will still be a little bit short because of Q1, but overall, for instance, Q3 volumes in India will be flat compared to Q2. In Europe, will be better than Q2. In fact, Europe Q3 volumes are expected to be closer to the Q1 volumes. Overall, for the year, we had given a guidance of volumes much higher than last year. I think 1.5 to 2 million tons will be in that range.
So one has to understand, let's say, at EBITDA level, sir, because the India standalone business now also includes the BSL business. So what happens to the India business post the BSL merger?
So what happens is post BSL merger, the Mira Mandli site, which is the Angul site of Bhushan, becomes like another site for us. Just like we have Jamshedpur and Kalinganagar, we have a third site. And so it becomes an integrated part of the Tata Steel ecosystem, which is good in one way because we've just had some amendments in the MMDR Act, and which means you pay a higher royalty even if it's a wholly owned subsidiary. So this way, when you merge it, then it's part of our existing enterprise. So there is a, in some sense, a leakage which we will avoid. So, and it also drives greater efficiency from multiple synergistic point of view, because there are many synergies that we've already driven as different legal entities, and when you make it one, there are many efficiencies that we can drive as one enterprise. So this was part of the plan. It took us a bit longer than we thought because obviously we had to go through the approval process at the NCLT level. So we've got all that, and now we are ready to go ahead.
Your cash flow generation is still strong, and your debt reduction, something which you've outlaid, is an ongoing process. But looking at your optimism on steel cycle and your operating leverage benefits which have kicked in, are you looking at retiring debt at a significantly more pace than what you earlier had indicated?
So when we started off 3-4 years back, we had said minimum $1 billion a year. Obviously, we are doing much better than that. We did much better than that last year, and we'll do much better than that this year. We've already done almost $2 billion in the first 6 months. So we are going quite strong on that. I think the guidance we're giving is our net debt to EBITDA will be less than 1 by the end of the year. We were, if you remember, we were at 4 or 5 levels a few years back. So at less than 1, I think we are extremely comfortable.
Is it a good idea to reduce that debt that much, because the interest rate environment globally is low? Tata Steel can raise money globally. What stops you from not reducing the debt and start putting that money back in capex? Because the changes which you talked about, where China is unlikely to export, US demand coming back, Indian demand coming back, these are changes where you really want to build capacity and take benefit of it rather than retiring your debt.
So we believe we'll be able to retire this debt as well as spend 10 to 12,000 crores a year of capex, which is what we've guided. We'll be very prudent about our capex. We will continue to support growth. We will continue to grow in India. We are adding another 5 million tons in the next couple of years with the Kalinganagar expansion. And we have the opportunity to take the India volumes to 35 to 40 million tons in the next 10 years. So all that can happen through organic growth. So we have that possibility. And if you have the net debt to EBITDA at less than 1, you have the headroom for anything else that you want to do. But I think we are conscious about spending our capital wisely. We will certainly protect our market share and grow aggressively in India. We will be very prudent about how we spend money outside India. And we want our businesses outside India, particularly the European business, to be able to stand on its own, which it's, I think, on track for.
How should one read into, Narendran, this whole emphasis which even Tata Steel has on ESG? ESG is something which is the new normal for all manufacturing companies. But ESG also will come at a cost, which means in the short term, less capacities will get created and it will lead to more inflation, and it will also lead to more uptick. Where do you think the balancing will happen?
So you've raised a very valid point, Nikunj, because obviously, there is a hesitation about investing in assets which are not seen as green, right? So which could lead to a demand-supply gap in some areas, if you don't manage the transition well. So the way we look at it, there is an approach for Europe, which is driven by what's happening in Europe. I think Europe is ahead of everyone else in the world in terms of setting goals and creating policies to support those goals. So in Europe, there is a transition plan which is being developed for our UK and Netherlands business in consultation with the government. Primarily, this transition cost has to be supported by the government and has also to be supported by the customers, who should then pay more for green steel, which I think in Europe, the context is there, the support is there. In India, with the net zero goals that have been announced and the 2030 goals that have been announced, we are looking at the policy roadmap and how it will evolve. Because, again, this transition will cost money, and the policy roadmap has to support that, so that we are not unfairly treated in this transition. So I think in India, we've already announced aggressive goals. We've said that our carbon footprint will be less than 2. We are already the benchmark in India as far as the carbon footprint for steel industry through the blast furnace route is concerned. We will bring it to less than 2 tons per ton of steel by 2025 and less than 1.8 tons per ton of steel by 2030. So those are quite aggressive goals, much below where we are, which is today at around 2.3. So I think we set the short-term goals aggressively, and we will pursue that. It's very important, as you said, and as a responsible corporate, we want to be a role model in this.
But could that lead to, again, that same point? I mean, in the short term, because of limited capacity addition, price inflation is going higher. Now, whether it is for steel or coke or iron ore, because ultimately everybody wants to be conscious, and this consciousness is coming at a cost which is leading to disruption. As a result, inflation has kicked in, price hike have kicked in. Where do you think the balancing will happen? Because prices cannot keep on going higher because of the ESG constraints.
So I think that's primarily the point which is being made even by the government of India when it says that the developed world, which has historically had a much bigger carbon footprint, should fund the transition for the developing world. So that in some sense, the commitment made at Paris was that at least $100 billion a year will be made available to the developing world to help this transition, to mitigate some of these costs that you're saying. Because in maybe the richer countries, you could afford to bear some of these costs, but in developing countries where a large number of people are still just about getting electricity, you cannot suddenly keep increasing the energy prices because of this. You need to find a way out. So I think that is why the transition needs to be managed very well. It is not a simple transition, and governments have to work closely with industry to make sure that it is not inimical to customers and to the common man.
The management of Tata Steel has indicated the following, which is Asian steel prices to remain range-bound, Indian prices to rise, and European steel prices to remain resilient. Can Europe be the swing factor which we've been waiting for? The debt challenges are behind us, demand is coming back, EBITDA is now in 3-digit. So what does the word resilient in Europe mean for you?
So there are 2-3 things in Europe. I think over the next few months, you will see the auto industry in Europe pick up. They've been struggling because of semiconductor issues, which is good for us because a lot of our steel goes to the auto industry. The second important development for Europe is the sorting out of Section 232 issues with the US, which means steel can flow from Europe to the US in a manner that it used to flow a few years back. Even from a Tata Steel point of view, we used to sell about 1 million tons of steel from Europe into the US, which has come down by about 50% in the last couple of years. US is a good market. We have good customers there, good equity there. And so we look forward to that. So it will give a better balance for the European business as US opens up as a market and the auto industry comes back. So I think the resilience comes from the positives that we see. Even if you look at this year, the steel consumption in Europe will be about 14 to 15% higher than the previous year. and will go back to pre-pandemic levels very quickly.
Can US and India on a combined level do what China has done to steel demand in last 10 years? Because China was in a sense the biggest guzzler of steel in last 2 decades. Can a combination of Indian demand coming back along with US infra spend make up for the drop in Chinese demand?
Absolutely. Even if you look at it this year, the World Steel Association forecast is that the steel consumption will grow at about 4.5%. And this is assuming there is no growth in consumption in China. So this 4.5% is actually coming from the rest of the world, which is probably the first time in more than a decade. And going forward, this will be the story because China is going to cut consumption and production. And China has already peaked from a percentage of world steel production and consumption. I think its highest was about 58%. It's expected to drop down to maybe 52, 53%. So countries like India, Southeast Asia, you have Africa yet to start because there are more than 1 billion people there and they're going to be 3 billion more in the next few decades. By the end of the century, you'll have 4 billion people in Africa. So I think there are multiple parts of the world which are going to be requiring a lot of infrastructure. There will be a lot of developmental expense. And on top of that, you have the developed world like the US announcing infrastructure spend like never before. So I think there is going to be a shift, structural shift as well in the demand. And China will no longer be the big driver of demand as it has been for the last 15 years. But other regions are going to certainly pick up the slack and more than make up for it.
We have seen a lot of volatility, Mr. Narendran, historically in steel prices, and that explains why steel stocks still trade at P multiples which are in single digit or perhaps in early teens, and that's largely because of the cyclical nature of the industry. But given how things are now opening up, how global connectivity is there, do you see a 3-4 year period of a predictable steel cycle with minor volatility here or there?
I think there will be volatility because of the nature of the industry. It's a global industry. Steel flows across borders. But I think it will be volatility at a higher level than, I mean, when I say high level, at a higher band than we've seen in the past. So, if you saw volatility earlier in the $300 to $500 range, I think you will see volatility maybe in the $700 to $900 range. That's my view, because there are these structural changes which have happened and the costs have gone up in multiple ways. So I think there will be some volatility. The second thing is the volatility may reduce going forward if China continues to export less, because they used to be the biggest factor driving the volatility because of the opaqueness of the markets in China and the impact it had on the global markets. If you see the volatility of steel industry over 20 years, the volatility increased as China became a bigger and bigger player. So as China exports less, makes steel for its own domestic use and insulates itself from the global markets, I hope that the industry outside of China will have a more stable future.
Right. Couple of final questions, Mr. Narendran. One is about your view on steel prices remaining volatile, but the bias will remain strong. Could high energy cost, could high inflation really puncture this thesis?
So what ultimately in an industry like this, few things will happen, right? I mean, high inflation means maybe central banks will increase interest rates, cost of capital may increase. So to that extent, expansions may slow down. If expansions slow down, that's not going to help bring down steel prices, right? So to me, there is that part one needs to watch out for. But I think this time, the big difference between now and 2008, let's say when steel prices went up very high, people were rushing to invest. You're not seeing people rushing to invest in steel apart from in India. India is the only country adding steel capacity, right? So there is a far more, I would say, prudent allocation of capital and growth, which means that going forward, you will not see the instability that we saw in the last 10 years. So that's why I'm a bit more optimistic. Yes, higher inflation may lead to higher costs. Capital won't be any cheaper. But in India, anyway, capital was never cheap. And, so I think there is an advantage for incumbents who have land and who can grow fast through brownfield expansion, and India is the only place which is adding capacity. So I think it's a very interesting place and time, but I'm certainly bullish for the steel industry in India and of course for Tata Steel.
Right, Mr. Narendran, really appreciate your time. So glad you could join us, and thank you for your valuable inputs.
Thank you, Rikuj. Always a pleasure.